Major indices such as S&P 500, NASDAQ, as well as ETFs such as technology, communication services, industrials, and high-yield bonds all broke to all-time highs, as I predicted a few weeks ago. We will look at the targets for S&P 500 and whether or not 7,000 points is feasible for S&P 500 by the end of the year. Dollar hit a 3-year low, but gold has not taken advantage of this, and in fact it pulled back towards the first support. I'll show you what that support is and what price action to expect in the near term. And 10-year Treasury yield breaks below key support as bonds rally. Yet President Trump says that Federal Reserve Chair should resign, but I think the market has taken care of itself. All this and more in today's edition of MasterChartsTrading.com market recap for Friday, June 27, 2025. Please don't forget to hit the like button, subscribe to this channel, share this video, and make a comment so more people can see it. If you are a subscriber, stay tuned. We'll be covering various securities in the members-only video. Market breadths, Bitcoin, crude oil, natural gas, as well as some of the Forex securities will be covered there. ETFs, large cap stocks, as well as speculative securities will be covered there. Several new ones that I've never even heard about. Melco Resorts, UiPath, Taysha Gene Therapy, Unity Software. They're all going to be covered in the members only section, so please stay tuned if you're a subscriber. If you're not yet a subscriber, consider signing up by going to the link in the description and following it to MasterChartsTrading.com. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com price action indicators, which you can see on this chart. There's green, blue, red, and yellow lines, which show us how to think of price action. We're currently looking at S&P 500. Last week I mentioned that since the high-yield bonds are hitting all-time highs already, S&P 500 will likely follow very shortly. Indeed, it did so this week, and we are now at new uncharted territory at all-time highs. As you can see on this chart, we have multiple gaps remaining, or rather, now we have a new one that was just produced. For example, this gap right there between 23rd of June and 24th of June occurred when the S&P 500 gapped above this previous high from June 11th, and now we're at new highs, and previous high was right there on 19th of February of this year, 2025. So what is going to start happening now is what's called a short squeeze. So what is a short squeeze? A short squeeze occurs when traders who think that this security, in this case S&P 500, will continue lower, and they bet, they place short bets, or they sell the security short, and normally they have a stop, and the stop is at new all-time highs. So once we hit all-time highs, those same traders will need to cover their short positions. Indeed, this is what's going to be happening most likely in the next few days to possibly a few weeks, as short traders get squeezed out by, basically, you can think about it in another way, is that as short traders get squeezed out, they're forced to buy the stock on an open market, and once they buy, that will drive the price ever higher. So that means that new traders will get squeezed out at new highs, and so on. And so this short squeeze could continue for quite some time. In fact, we can look at potential projection of what to expect from prices for S&P 500 in the next few months. So this is a giant V-shaped reversal, and normally we can look at this as the depth of this pattern, of this V-shaped pattern before the new highs were hit, and we can think of it as, how deep is this pattern. So very optimistic projection is from the very bottom to the very top, and we're looking at about 1,300 points. And what normally kind of could be considered is, where does this go? So most, normally this kind of, it's called a range flip, or you can say this entire pattern will be duplicated on the upside. How fast it will be duplicated is, anybody's guess, but we can, just pretend that it's going to continue about the same way. That's another 1,300 points, or 21%. So can it happen by the end of this year? Absolutely. If it just continues nonstop the same trajectory. It's quite, significantly overbought already, but during the bull market, which we are in definitely right now, the overbought becomes normal. Like, we're normally overbought during the bull market. We're abnormally oversold. I mean, here we can argue that this whole thing was, in April of this year, was even a short bear market. But then once we, closed above the blue support resistance line, which is one of my indicators, you can see that we're continued higher. This is basically a new bull market, and now we're at new records. So theoretically speaking, we could see prices for S&P 500 in the 7,000s by the end of this year. It is a very optimistic projection. However, I still think that right now we're in a bull market, and I mean, we might get a pullback, but there is no way to know when this pullback will unfold. What if we move, towards like 6,500 and then pull back a little bit towards this breakout point and then make another high? Versus we will immediately close all of these gaps by moving backwards. So yes, indeed, we have 1, 2, 3, 4 gaps that I can count. Maybe there is a small partial gap here as well, maybe a tiny one between 30th of April and 1st of May, but it's partially closed already. So as they say, markets hate vacuums, so a pullback is likely, but once again, we don't know from what levels. So maybe we'll close this gap right away, maybe we won't. What we should be concentrating on right now is looking for opportunities to buy stocks. And that's what we've been doing. NASDAQ, this is QQQ, NASDAQ actually broke 2 new records a little bit earlier on the 24th of June, whereas S&P, it wasn't yet records. It did gap, but didn't get gap to records on the 24th of June. QQQ actually gapped to records. There is a gap right there between 24th and 23rd and 24th of June. And it gapped to all-time highs. So previous all-time high was right there on the 19th of February. I actually have a position open because I bought NASDAQ myself right there on the 8th of May. So I'm sitting in the position still. I did move my stop to entry. I moved my stop to the blue line at this point. So this indicator is basically very much show how to read the price action. They're quite easy to follow. You can find out more about them. So NASDAQ is leading stocks higher. I think it's a good thing. I think technology is a very quote-unquote offensive sector. Versus things like defensive sectors like consumer staples or utilities. So it is a good sign that the offensive sectors such as technology are leading stocks higher. So NASDAQ at all-time highs. Another sector that hit an all-time high is XLC, communication services, things like Meta, Google, AT&T, Walt Disney, Verizon are in here, Netflix as well. Also, we're hitting all-time highs. Also, same thing, we gapped to new records on the 23rd, 24th of June. So XLC communication services are doing quite well. Technology sector also gapped to all-time highs on 24th of June. Within it, there are things like Microsoft. I think it's driven, this thing is driven by Microsoft because Apple is lagging right now, but NVIDIA is doing quite well. But if you see the percentages, Microsoft is 24%. Apple actually is still kind of lagging below, while Microsoft, you can see it's at new records. So XLK technology doing quite well, driving the markets higher. So once again, technology, communication services, big, very large sectors of the current composition of the S&P 500 are offensive in nature, and they are driving stocks higher. Another sector that just hit records is the XLI, also known as industrials sector. Within it, there are actually some quite, useful in the sense of offensive also. They drive growth. Things like Uber, Caterpillar, Boeing, all of these companies, they depend on robust economy, so they are also in that sense offensive in nature. So that's also, this one actually went to records even earlier. It went to records even in May of this year and continued higher. So right now we're again at all-time highs. So three sectors within the S&P 500 at records: industrials, communication services, and technology. Is a good thing for the market. High yield bonds, and this is the most important one in my view. This one, I kept saying that when junk debt went to records, and it went to records actually in May 12th, right there where I'm hovering, while the S&P 500 was still kind of just bringing up slightly. And I was like, this is a bullish divergence, meaning that the technologies, or rather the high yield bonds, are driving the this divergence higher, because you have to understand that high yield bonds, they have a high degree of correlation to the S&P 500. So notice on this chart of high yield bonds, this below here is this graph in yellow is the correlation coefficient, how close the S&P 500 and high yield bonds follow each other, and they basically doing the same thing for a very rare occasion. And currently they have a very high degree of correlation. So when I saw high yield bonds at new records here in May, I was like, we need to be thinking about buying stocks, not selling them short. And I was correct. Right now we are again hitting records for high yield bonds, and I think this might continue. We don't know exactly for how long. Let's switch gears. We're currently looking at dollar currency index, ticker symbol DXY on tradingview.com. Dollar just hit a fresh 3-year low right there. And the only reason why I look at the dollar is because at Master Charts Trading we trade gold. And normally when dollar goes down, gold goes up. Why? Because gold is traded in dollars, so gold divided by US dollars. When this bottom part of this equation, the US dollar is smaller, is getting smaller, then this graph should get bigger. It should be moving higher. In fact, it's been doing something of that nature. However, over the past few weeks, you can see that gold since June 13th here has been moving lower. And if we look at the dollar, we also have been moving lower. So right now it's a weird situation where both dollar and gold are moving lower. And as a matter of fact, gold just broke this first support marked by my green line right there where I'm hovering. So today actually this is what happened. You can see that the gold broke support. And it might be headed lower, just the way things are happening right now, because this in general is a very bullish pattern. I'm going to draw it out. This is basically like an upside down W or something. So when or if it broke out higher, it would have been quite bullish, and like this entire pattern, let me show you which pattern I'm referring to. This pattern, this depth of this pattern would have been duplicated on the upside, and that's what I drew here before. So we would have, if it broke out above this previous high from 22nd of April, I think we would have been easily moved towards like 3,900 for gold. However, right now it hasn't happened. In fact, right now we're doing the opposite. We're breaking down. And so that's what I am sort of concerned about. Is it's weird because, like, dollar just moved to new 3-year lows, and gold also broke down. It's unusual for that to happen. So two things could be unfolding. Dollar could rally from this point, and gold is already sensing this potential rally for the dollar, and that's why it's dropping. Another possibility is gold will finally, come to grips and make another high with a low, come to grips with a low dollar and make another high. So two possibilities here. I sort of, just from the way this chart is looking, especially today's candlestick is not ideal. You can look at the weekly candlestick as well. The weekly candlestick is also quite, red and big. This is the second week in a row we're dropping. I actually think we're gonna pull back. I have my feeling is that we're going to be pulling back towards this blue support resistance line at around 3,000. So again, my support resistance lines that you can have on your chart. So about 3,000 would be a pullback of about 6% or so from today's price levels. This is also being shown in gold miners, GDX. So notice gold miners hit on the 13th of June, hit a 24-year high, almost an all-time high, has been pulling back now close below this green support resistance line. So again, they're doing the same thing as gold, but as I described the situation with the dollar, normally dollar dropping would be beneficial for gold, but right now it seems that gold is not really taking advantage of this. So I wonder again if we will continue pulling back. And another one I wanted to cover is the 10-year Treasury note yield. Several things here. This is another thing about the world. Trump says he terminated trade talks with Canada on Friday, so we're going to have to wait until Monday to see any results of the, any fallout, so to speak. But another important one was this one. Trump says he would love for Powell to resign. So interesting. I already see that this has been priced into the market already. So the drop in yields is already happening without any intervention from Federal Reserve. Powell is really under pressure from President Trump, but maybe it will just happen automatically with bonds, actually going higher. Here's IEF Treasury bonds. We are trading them. So again, use the same principle, using indicators. We buy and close above the blue line. Notice where the lines are. Notice where the arrows are. And the latest opportunity was pretty successful, and we're actually at the green line right now. So the 10-year Treasury note yield broke below important support of 4.36%, marked by my blue line, and continued lower. So we're currently around 4.2% for the 10-year Treasury yield. If this bond rally continues, which I don't see a reason for it to stop, I think we will obviously, continue dropping. The interest rates will obviously continue dropping. So if or when we get to this 406 level, like that, that would be beginning of a new bear market for bonds. I'm sorry, for the yields rather. So if we break below 4.06, I think the yield would continue even lower towards like 3.6%. Now the reason for that might be because of the economic activity slowdown, because of the lowering of interest rates by the Federal Reserve, maybe some other reason, but the market seems to be just taking care of itself without interventions right this instant. And that's it for this week's recap. Again, if you have if you are a subscriber, stay tuned. We'll be covering lots of various securities. Head over to masterchartstrading.com. Click on sign up. Again, I have two plans. I have the trading indicators and the newsletters. So the trading indicators are these lines on the chart, which you can use to trade pretty much anything under the sun. They are available for tradingview.com. This interface. So all you need to do is open a free TradingView account. Once you open a free TradingView account, come back to Master Charts Trading, sign up, and I will open the door for you on TradingView. If you only need my ideas about the trades, sign up for the newsletter. So, for example, this week we'll be covering all of these various securities: Bitcoin, crude oil, natural gas, some of the forex instruments, ETFs, large cap stocks, and some of the speculative securities that you see on this outline. And of course, the best deal is to get both trading indicators and newsletters. If you get the yearly subscription, you get 17% off, equivalent of the monthly rate. And of course, as always, you get free 7-day trial for all of my plans, so you have 7 days to cancel if you don't like it. Again, that's it for this week's recap. Please don't forget to hit the like button, subscribe to this channel, share this video. Thank you for watching, and have another great trading week. Bye bye.